Symbotic burned $300 million in cash sequentially, and the release never explains where it went. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Symbotic gets graded and traded. So on the headline, revenue came in less than 1% ahead of estimates at $721 million. But the real story is that's up 22% year over year, and the systems business grew even faster than that. And on EPS, they actually missed by 25%. But here's the catch. Only $11.7 million of the $55 million net income actually accrues to common shareholders because of their corporate structure. So diluted EPS came in at just 9 cents. So on the beat itself, this earns a D. A tiny revenue beat combined with an EPS miss is not a headline surprise, no matter how strong the year-over-year growth looks underneath. And on consistency, this also lands at a D. The track record of clean beats on both lines just isn't there for this name. Let's talk about the positives from the report. Total revenue hit $721 million, up 22% year over year from $592 million. And the core systems business grew from $559 million to $671 million. Customer deployments are clearly accelerating. Adjusted EBITDA more than doubled to $95 million from $45 million a year ago. And GAAP net income swung to a $55 million profit from a $21 million loss. That's the operating leverage inflection people have been waiting on. Management guided the fourth quarter to $760 to $780 million in revenue and $100 to $105 million in adjusted EBITDA. They're basically telling us margin expansion continues sequentially. The CFO called out 77 systems currently in deployment. That's contracted work still flowing through revenue over coming quarters, so the forward visibility is real. And cash sits at $1.7 billion. Even after a sequential decline, that's a big cushion to fund the Exol JV, the Walmart Advanced Systems acquisition, and the New Mexico agreement. So, on profitability, this earns an A-. The adjusted EBITDA doubling and the swing to GAAP profitability is a genuine operational inflection, not just top-line noise. Now let's talk about the negatives from the report. Cash and equivalents dropped $300 million sequentially, from $2 billion to $1.7 billion in a single quarter, and the release never explains where it went. That's a big open question for a company still ramping profitability. The equity method investment loss widened to $9.6 million for the quarter, up from $3.8 million a year ago. Year to date, it's $22 million versus $7.8. The Exol JV is absorbing accelerating losses that flow straight below the operating line. Stock-based comp came in at $50.5 million for the quarter, roughly 7% of revenue, and it's $151 million year to date. Treat that as a real cost, and the $95 million EBITDA figure gets a lot smaller. Non-controlling interest absorbed $43 million of the $55 million in net income. Only $11.7 million actually accrues to common holders. So the headline profitability massively overstates the per-share economics. And the customer concentration on Walmart is still structurally there. The New Mexico deal deepens that exposure rather than diversifying it. So on guidance, this earns a B+. The Q4 outlook of $760 to $780 in revenue and $100 to $105 in EBITDA is a clear signal that both growth and margin expansion continue. And on red flags, I'm at a C. The $300 million cash decline with no explanation is the one thing I can't just wave off, and the widening JV losses stack on top of that. Putting it all together, Symbotic delivered a genuine operating inflection this quarter. EBITDA doubled. They swung to GAAP profitability, and the Q4 guide says the margin expansion keeps going. But the per-share picture is way less dramatic than the headline suggests, and that unexplained $300 million cash decline is a real question I want answered. This print earns a C+ from me. Strong operationally, but there's enough noise below the surface to keep me disciplined on sizing. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. This print backs up the operating leverage story I care about, so I don't feel any pressure to chase the pop here. I want to let the implied volatility crush fully play out, which usually takes 2 or 3 sessions after the report on this name. Then I stage in with cash secured puts at lower strikes across 1 or 2 weeks instead of dumping everything into one position. So my plan is to stage in with cash secured puts after the implied volatility crush. The fourth quarter guidance of $760 to $780 million in revenue and $100 to $105 million in adjusted EBITDA gives me a real floor to anchor my strikes to. I'd only sell a strike near the ceiling if I genuinely welcome getting assigned, given the 77 systems in deployment and the joint venture optionality. But I'm staying away from at-the-money strikes until somebody explains that $300 million sequential cash decline, so I keep my puts well out of the money. I'm anchoring my strikes to the fourth quarter guidance and staying wide out of the money. Adjusted EBITDA doubling and the swing to GAAP profitability tell me the ownership case is intact for at least another quarter. The only reason I'd trim my shares is if the position has grown uncomfortably large after this pop, purely for sizing reasons. Otherwise, I let the shares ride into fourth quarter execution against that $760 to $780 million revenue guidance. So I'm holding my shares and letting them ride into the fourth quarter. The covered calls I sold before earnings, I just let work through expiration and take what I get. If I get assigned on a post-earnings pop, the stronger profitability picture makes it easy to re-enter with cash secured puts at a lower level. For any new covered calls I write, I'm pushing strikes further out of the money than the pre-earnings math would have suggested, because the raised guidance and the Pagliuca board addition create real upside room. I'm letting my existing calls work and pushing new strikes further out of the money. The profitability inflection is actually demonstrated now, instead of just projected, so I'm holding my long-dated calls with more confidence than I had before this print. If my leaps are deep in the money, I'll consider rolling the strikes up to lock in some intrinsic value while extending the duration out further. But I'm not taking full profits here, because the structural story around Symbotic winning in warehouse robotics has gotten stronger, not weaker. I'm holding my leaps with more conviction than before. This release validates the original bullish story on operating leverage, with adjusted EBITDA doubling and GAAP profitability finally showing up. If I were underwater here, I'd treat this as a hold and add situation. But the unexplained $300 million cash drop and the equity method losses tell me to add in measured pieces, not aggressively. I'd wait for the implied volatility to settle after earnings and then use cash secured puts below the current price rather than buying shares outright to improve my cost basis. I'm holding and adding in measured pieces using cash secured puts. Bottom line, this print earns a C+ from me. The operating leverage story is now proven rather than projected, but the cash burn and structural share count issues mean I'm sizing carefully rather than getting aggressive. Thanks for watching, and I'll see you on the next one.